Hello and welcome to today's webinar, How to Build a Financial Plan That Investors Will Love, presented by Early Growth Financial Services. My name is Patty Montoya and I'll be your moderator today from the Early Growth Financial Service team. I have a few quick notes before we get started. First, the webinar will last about an hour and that includes time at the end for questions. So feel free to type your question into the control panel and we will answer them in between slides. The next thing to note is that this webinar will be recorded and sent to all the registrants with the slide deck within 48 hours. You can also find the recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speakers today, I'd like to tell you a bit about Early Growth Financial Services. This is a quote from our founder, David Ehrenberg, and a few of the clients we work with. And here's a quick description of what we do. We're an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. Now, without further ado, I'd like to introduce our panelist, Sirk Roh, who will tell us a bit about himself and kick off today's discussion.
Hi, everyone. Thank you very much for taking time out of your busy schedule to spend an hour with us. First note, just wanted to apologize. We were also supposed to be joined by Ala Ismail, one of my my partners at Early Growth. Unfortunately, he got called away by a client issue that he had to deal with. So he's not going to be able to join us today. So it's just going to be me. A little bit about myself. I am a principal and consulting CFO with Early Growth Financial Services. I've been with the firm, I think, coming up on 6 years, and have assisted lots of early stage companies in various industries, SaaS companies, hardware companies, software companies, even some consumer product companies. And prior to that, I held roles in finance at other startups and other tech companies here in Silicon Valley. Okay, so before we even get started into the actual specifics of the presentation, let's just talk a little bit about kind of what we're trying to do here, right? We're trying to put together a financial model that achieves several things, right? One is it kind of gives us an operating guideline and a management guideline to assist us with managing the company. But first and foremost, the most important thing is that it kind of gives us what we think the financials are going to look like that we can be presenting to potential investors as one of the tools that we're going to be using to try to gain their trust and confidence so that they will invest in our company. And so to that point, one of the big things that we are that we want to highlight is all the things that we're going to be doing is really going to be trying to make sure that the numbers, we know the numbers cold, we know all the assumptions behind them, and that when we present the financials along with the pitch deck and other investment paperwork, that the investors or potential investors are going to have confidence in us as founders and as managers. And so that's kind of the key thing here. So kind of going into some of the more specifics, the first thing that you need to kind of be aware of is that you need company buy-in. Now, if you're a really, really early stage company, the company may just be you and one other founder, or just you and a few engineers. In which case, then obviously, then the company buy-in is not as extensive. Later stage companies where you have departments and you have VPs and other officers that are responsible for different parts of the company, you clearly need to get company buy-in on your financial plans so that everyone is kind of marching to the same rhythm, and that there are no surprises and people don't feel feel like they're not being given the resources to be successful. So keep that in mind. Obviously we want to make sure that we understand our key objectives as we prepare the model. We really focus on the major milestones, and all of our fundraising really is focused on that, right? So we don't want to raise so much money initially that that we're going to get to necessarily break even. We may, but most early stage companies spend money over a period of time developing their product and gaining customer traction, and it usually requires, or many times requires, multiple rounds of financing, and we don't want to raise so much that we dilute ourselves immediately, or make it seem unreasonable that we're going to be able to raise the amount of money that we're looking for. So we want to do it over tranches, and as we're doing that, we want to make sure that we are meeting the objectives and our milestones that we've set for ourselves, because then obviously that paves the way for future investment. And I think I've already talked about this a little bit before, but we want to make sure that we have agreement amongst the leadership team, to the extent that there is a leadership team, or potentially just between you and a co-founder. Okay, next slide, Patty. Okay, so just in terms of just at a high level, spending by department, again, this is more focused on if you actually have different departments. You may have an R&D department, you may have sales department, marketing, and G&A, or general and administrative. And so you just want to make sure that to the extent that we are putting together a financial plan by department, that you want to make sure that each department has the resources. And these are some of the kind of the spending buckets that you're going to want to make sure that we cover. Staffing for most of our company or most of our clients is by far and away the biggest spending bucket, and so we need to make sure that we have our headcount planning and our salary expectations in place. Other professional services, outsourced services, whether it's R&D, whether it's G&A, or whether even in sales and marketing, we want to make sure that we cover our needs there, contracts and consultants, and then other things like obviously travel and entertainment, marketing, and then the one thing that probably isn't added in here is kind of like general office expenses.
Sirk, we have a question.
Yes.
If you're raising via convertible note, then why cap early seed financing?
I'm sorry. What if we're raising a convertible note? What's the second part of that question?
Then why cap early seed financing?
Cap early seed financing. I'm not sure what the question is.
Okay, I can ask again. And we have another. Okay. The other question is, what percentage of spending should be in the marketing bucket?
So we'll get to that in a little bit. We'll get to that as we dive a little bit into more details about stuff like that. So please be a little bit patient while we go through this, and then we'll get to that. Okay, so on the revenue side, there's some things that we would probably recommend. Obviously, if you have a trend, so if you already have revenue and you kind of have a trend of what's happening with revenue, then that's obviously a good place to start. We rather than saying this is how you should do it, there's probably a couple of things that we want you to focus on, right? So understanding the revenue drivers, right? And whether we're making some assumptions about market size and kind of dwindling that from a total available market to a serviceable available market to a serviceable obtainable market, or whether we have some good ideas in terms of a bottoms-up projection of the number of customers that we want, and some of the drivers of, for example, the amount of revenue per customer, how much we're spending per marketing spend to get each customer, whether we have those kinds of metrics in place, or we feel confident about using those to estimate revenue growth. You should do that. The one thing that we would probably recommend you don't do is do kind of this general revenue growth assumption, right? 5% per month, or 25% year over year. Those, while they may be helpful as a a number to kind of reach for, we need to have the underlying assumptions that really that drive to those numbers, as opposed to just using a, hey, listen, I know we can grow this business by 3 to 5% every month for for the next 2 or 3 years. That is kind of a recipe for questions that are hard to answer when investors ask. Okay, and obviously you're going to want to create spreadsheets. That's how we put together financial models. Whether you use a Google or Excel, those are the two main ones. To kind of stick with that. If we do have different departments, and you want the executives of each of the departments to be responsible for their forecast and the budget, then obviously you're going to want to create a separate worksheet for every department and have it all roll up into an entire corporate department. You'll definitely want to have a separate worksheet just for revenue, or even multiple worksheets to get to our revenue forecasts and projections. And we talked about some of the ways that we would do that, or some of the things that we would want to use. And then one of the things that we really stress is having an assumption worksheet, right? And we'll talk a little bit about kind of what some of the assumptions are. But most models, most financial plans are really depend on some handful, some small number, 5, 10, maybe 15 key assumptions, and that's going to drive 90 to 95% of the model. And so understanding what those key assumptions are, being able to put that into a worksheet so that we can manipulate those really easily and see what happens to our model as we make changes to those assumptions, is going to be key for you to understand, first of all, what the drivers are of our business, but also gives us the opportunity to be able to make changes on the fly, adjustments as needed to what if scenarios and multiple scenarios. And so kind of, going a little bit deeper into these key assumptions, so we've already talked about the 5 to 10, maybe some more. It just kind of depends on your business, but just really understanding what those are, right? So you're not going to focus a lot of attention on things like office supplies, right? Even though that's a line item that you absolutely have to have in your forecast, it's not something that you're going to want to spend a lot of time, ferreting over. But things like how many people do we have to hire? When do we have to hire them? What kind of salaries are we going to have to pay for those hires? How many salespeople are we going to need, and when? And how much revenue can we expect from every salesperson we hire over what time? What kind of marketing spend do we expect to have? Things like how many R&D employees and how many R&D outsourced contractors are we going to need to be able to get our product done? And in what time frame are we going to have that product done? These are some of the key assumptions that we want to focus on, especially the early stage, because you're going to see that things like, okay, well, I put in a plan that says we're going to hire these many engineers and these many salespeople, but then you'll realize that, boom, if we have a 3 to 4 month delay in product availability, it really wreaks havoc on the numbers. And understanding what some of those drivers are and making those kinds of changes to our assumptions as we go along will give you a lot more insight into the business, and be able to make sure that we identify problem areas early on, rather than after it's too late. Okay, in terms of the actual budgeting and financial planning, we've talked about the key variables. Obviously we need to spend a good amount of time on looking at our revenue assumptions, right? So if it's, if you have a SaaS model or a software as a service model, there's lots of revenue metrics that you're probably aware of. Customer acquisition cost, lifetime value, churn, those types of things. Lifetime value of customer. Those kinds of assumptions you should be able to either have have at your fingertip, understand kind of what the industry averages are, and use those. Use comps if you're able to find other comps, but making sure that we understand what the key revenue assumptions are is going to be absolutely critical. We've talked a little bit about run different scenarios, right? So I'm a huge believer in running 3 different scenarios, right? The expected case scenario, the best case scenario, and the worst case scenario. And then you have kind of this, this range of potential outcomes that you can drive towards. And in terms of actually putting together a model that investors are going to feel confident in, we need to understand, okay, so one of the questions that I'm sure that you're going to get asked by investors is, okay, well, what's the downside, right? What happens if we're not able to produce the product in the time frame that you expect? What happens if a customer, a big competitor comes in and takes some of the market share that you are expecting in your plan? So what happens in those cases? And to be able to run those scenarios really quickly, to have already done them on paper, so that you already are able to answer those kinds of questions, again, will lead to confidence in the investor's mind, in your ability, your knowledge of your company, and your knowledge of the industry, and your opportunities, so that they can feel confident in making an investment in you, which is really ultimately, obviously, the bottom line. And then, we say, how long do you want to forecast for? Again, it kind of depends. Every company is going to be a little bit different. For really early stage companies, and I think that's kind of, who we're speaking to mostly on this presentation, you're going to want to do a 3-year plan at most, right? And because it's just, at an early stage, it's really hard to forecast beyond that. Even 3 years, I'm sure most of you are probably thinking, boy, I don't know what's going to happen to my business 3 years from now. But put some assumptions down in terms of where you expect to be, what kind of market share you expect to have, what kind of revenue growth you expect to have, and what kind of headcount and expense structure you expect over this time frame. And then again, you'll be able to kind of layer that on top of the assumptions that you have, and kind of going back to this milestone financing, you'll be able to layer your milestones on top of that and make sure that it jives. And then it'll give you an idea of, okay, well, this round of financing I'm going after is going to last me 18 months, right? It's not going to last me the entire 3 years. But here are the milestones that we expect to achieve with this initial round of financing. And 12 to 18 months from now, we're going to have hit these milestones, and then we're going to be able to raise our next round of financing, which is going to take us, the next 18 to 24 months, or to break even, or whatever the case may be. But the idea is, again, to have to be forecasting into the future, to the level where you have some confidence, what you're trying to achieve. The financing objective meets those objectives, and you have good confidence, and you're able to communicate that good confidence, high level of confidence, to your potential investors. Okay, so in terms of fundraising prep, we talked a little bit about milestone fundraising, and we want to spend a little bit more time here, because this is really critical. And I understand that this is a presentation more on building a financial plan, but we want to spend a few minutes on making sure that everyone is really on board with this, right? Because as I mentioned kind of at the top, we want to raise funds that meet our objectives, obviously, but we need to shorten that time frame, right? We may have a 5-10 year plan. We may have an exit strategy several years down the line, whether it's an IPO or whether it's a sale of the company to a bigger company. We may have all those plans. However, we need to be really focused on what those milestones are. What those milestones are within the time frame that we are looking in the 3 to 5 year time frame, and then being able to plot that on the timeline, right, along with our financial plan. And by doing that, basically, then what we say is, look, if we use the financing that we're trying to raise today, if we use that to hire the people that we need to hire, build the product that we are expecting that we know we need to build, and get the customer traction that we expect, then between those kinds of things, then we are going to set ourselves up so that 12 to 18 months down the line, as our funds from this initial raise is dwindling, that we will have met the objectives, and the next fundraise is going to be easier. It's going to happen at a much greater valuation, and therefore, obviously, minimizing dilution down the line. Your current investors will be happy to see that, and new investors in the next round of financing will be throwing money at you, if we're really successful. And then if you think about kind of like what that valuation picture looks like, so what's going to happen, hopefully with our company valuation is when we first get started, obviously we're not worth anything. As we come up with an idea, a product idea, and do some research into the market opportunity and where we fit in the market, and the expertise that we bring to our company, and start building product, then obviously our valuation of the company grows. But you'll find that the valuation of the company isn't a linear line that slopes upward. It's not even a curve, right? It's going to happen over step functions, and those step functions, those big increases in valuation, are going to happen when we hit major milestones, right? It's going to happen when we finish our first beta or our first available product. It's going to happen when we get the number of eyeballs on our website that's in our objectives. It's going to happen when we get the customer traction, right? So when we show each of these things happening, these objectives, these milestones, we're going to see a big jump in valuation. And so we want to raise funds to meet those milestones, right? So we want to raise funds today. That's going to allow us to hit our first 1, 2, 3 milestones, whatever they may be. And if we hit those milestones, then that next round of financing that we go after is going to be at a much, much higher valuation, and therefore much less dilution to both yourselves as founders as well as to current investors. Make sure that you give yourself a little bit of a buffer when you're fundraising, obviously. Not everything goes to plan. In fact, in most cases, companies pivot, right? Make pivots during the way. While they're developing product, maybe they see a use case that they didn't think about initially, and it's an easier market, target market to go after, and so we make a little bit of a detour to go after that market first. Maybe a competitor comes in. Maybe something like the market opportunity just explodes, and we want to throw more resources at it because timing to market becomes more critical, and we find that out 3 to 6 months down the line. So make sure that you have a buffer in place for any pivots that happen along the way, or the inevitable delays that occur that are kind of unforeseen when you first put together your plan. Okay. So some points here about kind of trade-offs. We talked about, okay, after you complete a budget, things are going to change, right? And so we just need to make sure that we are that we're being nimble, that we are being quick. As new information comes along, that's one of the huge advantages of an early stage small company, is that we're not like the Titanic, right? Trying to make a turn in the ocean. We are small and nimble, and we can make decisions quickly and act upon those decisions. And so, to the extent that we get new information, we should be ready to make pivots along the way, and we need to also have a financial plan that's easy to revise and update, and change assumptions along the way, so that we are continually understanding what's happening with our financial model, our cash burn, all those things that are critical to us. To the extent that we have investors now, we need to be obviously communicating any pivots that we're making along the way as quickly as possible. One of the key questions along the way is going to be, okay, so what does this mean to our cash burn? What does this mean to our milestones? What does this mean to our future fundraising plans, and those are that is information that you're going to need to have. And so again, having a financial plan that's conducive to making those kinds of changes and revisions and updates is going to be critical. And so just keep those in mind. And again, if we have these assumption pages, or if we have a set of assumptions that are really the drivers of the business and the financial model, being able to manipulate those, make changes to those, and see what happens to our financial plan going forward is going to make it a whole lot easier for you and give you confidence in the numbers. Okay, in terms of time frame and forecasting, so we talked about the fact that we want to put together a plan that looks out 3 years. That's what investors are going to be looking for. So it's not just about how much money or where we're going to get with the money that we're putting in today, but what are the plans for the next round of financing and where we expect to see in terms of expenditures, revenue, market share, all of those things. So keep that in mind. We talked a little bit about kind of changing again, but again, having a financial plan that you're able to dynamically update on an as needed basis, or whenever is needed, or when assumptions change, and being able to maneuver our company not only from a financial plan perspective, but from an operational perspective, is going to obviously, again, gain confidence of your current investors and any new investors that you may be going after in the future. And so just, always, be looking at your financial plan. Don't put together a financial plan and then, put your head down and forget about it and just kind of, bull your way through on an initial plan without kind of thinking about, looking at your financial numbers on a regular basis. And then obviously, of course, cash burn, right? So the cash burn is, regardless of, what your P&L looks like, and when I say P&L, profit and loss, or income statement may look like, obviously, early on, cash burn, cash position is a critical thing, and cash burn may be similar to your P&L or your operating loss, but it may be very, very different depending on what kind of business we have. If we have a business that has to purchase a lot of fixed assets, or if we have a business that has to purchase inventory, that is going to drive cash flow, beyond what your income statement may look like. Similarly, if you have a model where we are a B2B business, for example, and we are invoicing our customers, and it takes, our customers, big customers, 60 plus days to pay us, then that kind of, cash gets kind of sucked up in accounts receivable balance, and we don't actually have use for it. So, make sure that not only do we understand what's happening from our income statement perspective, but make sure that we understand what's happening with our cash burn. And those are two, kind of different things, although they may be similar depending on what kind of business and financial model we have. We talked a little bit about kind of gathering some information. Obviously, we talked a little bit about trend analysis. So to the extent that, we have a history, either from just an expense structure or both expenses and revenue, then we should be using that. And that is going to be a great baseline to use to build, into the future. Right. And so obviously, if we have that, we should use that. To that point, same thing with, prior year revenue and spending. And then, to the extent that, we kind of have a plan in terms of hiring, how quickly the revenue is going to grow, where are we in product development? What enhancements are we making? How are the enhancements that we're making to our product or service, how is that going to impact the way that customers sign up with us or the revenue? What kind of people are we going to need to support that increasing revenue? Right. So all of those kinds of changes in the future are what we want to make sure that we include in the assumptions of what our numbers numbers are going to look like. Obviously, and we get this a lot. Hey, Sirk, you know what? We don't have that, right? We're really looking to raise our first round of financing here. I'm trying to put together a model. I totally understand the theory behind kind of using some key assumptions, but really I don't have that kind of information. So where do I start? Well, I would say that you want to do your research and look at existing businesses, right? You can get a lot of financial information that's publicly available from existing companies. You should obviously have an idea of your industry, other players in your space, potentially, I guess congruent spaces. But there's lots of places that you can go to, and actually just being able to just saying that, hey, listen, I don't have history, and therefore I'm kind of throwing up my hands in terms of putting together a financial plan. That's obviously not the answer. And so we need to go out and get all the available information that we can. Talk to friends, talk to other entrepreneurs who've been through the process. Talk to develop mentorships with other people in your industry that might be able to help. Talk with financial advisors like us, right? We have lots of experience helping early stage companies put together financial plans, and so use whatever resources you can to come up with your assumptions and the information that you need to put together a great plan. Okay, and then we'll talk a little bit about the actual specifics of putting together a plan. There's several different ways of doing it, and this is kind of where we're going to start getting into that one question that I think one of the viewers had about marketing spend percentages and things of that nature. So there's really there's multiple ways of doing financial plans. We talk about things like top-down financial projections, bottom-up financial projections, and we'll dive in more detail into each of those. The key thing is that both of these kinds of projections are really important exercises. Neither one of them are to be used by themselves. We really should be looking at and being able to confirm the assumptions that we're using and how they roll up into the financials in multiple ways, right? And so we'll want to do both. But let's kind of dive into it, and we'll spend a good amount of time in talking about both the top down and the bottoms of financial projections. So, Patty, if you could go to the next slide. Okay, so top-down financial projections. So the main way that we want to use the top-down financial projection is to really look at our revenue potential, right? And this is kind of where we if we don't have a history, right, to be able to base our revenue projections on, then this is kind of one of the ways that we would do it. And this is kind of an industry understood method. And you're not going to get pushback in terms of the methodology. You may get pushback in terms of the assumptions that you're using, but this is one of the main ways that you would do it. So you start with a total market size, right, or the total available market, the TAM, right? And then of course, the market is probably going to be big. We want to be going after big markets. Investors, VCs and angel investors are not going to invest in a company that has a very, very small potential total available market. But of course, we're starting out, right? So we're not gonna dominate the world in year one or year two. Instead, we're gonna be focused, right? We're gonna be going after a segment of that total available market, whether it's and you can segment your market size by specific individual smaller markets within the total available market. It may be geographic, it may be limited by geographic locations, whatever those market segments may be. And the idea is that we want to be focused on a specific segment of the market That's what we're going after. That's the product development that we are developing, with obviously, plans in the future to be able to move outside and to be going after adjacent markets, and ultimately, if our plans are grand enough, then to be a major player, being able to go after the total market. But initially, you're going to be going after a particular market, right? And then when you actually put together that revenue potential or the revenue plan, you're going to be saying, okay, well, this is the particular segment that we're going after. So the serviceable available market, which is the SAM. And then, what I would say is then you narrow that down or funnel that down even a little bit more, and you say, okay, well, this is the available market, and this is how much we think we can obtain, right? So what market share are we going to have in month one, in quarter one, in year one, when our product or service is available, right? And so if we use this kind of funnel approach and say we start with a total available market, we whittle that down to the serviceable available market, and then we whittle that down to a serviceable obtainable market, then you've got what I would say is a revenue potential that you can justify, right? You clearly have to still make the argument of why we think we are going to be able to get the market share that we have in our plan, but at least we now have a methodology that you can support, with arguments as to why we are saying that this is the kind of revenue we expect to have in our financial plan. And then now kind of touching upon a top-down financial projection, and matching this with a question that was asked earlier about what percentage of revenue should be marketing. So this is where my answer is it depends, and I know that's not very satisfying, but it really does, right? And we want to be careful about using a top-down financial projection to get to expenses, right? Because that's basically what the question was, right? Which is using a top-down financial projection to say, okay, well, I've got this revenue base, and I'm going to say I'm going to spend a certain percentage of that revenue in sales, and I'm going to spend a certain percentage of that revenue in marketing, and a certain percentage of that in R&D, and a certain percentage of that in G&A. And I think it's a good exercise to have a percentage in mind over time. That percentage is going to change, right? Obviously, when you first start out, you're going to be, you're first of all, you're going to have no revenue, so the percentages are going to look a little bit wonky. If you base it on a percentage of revenue, when you're first getting going, depending on how fleshed out the product or service is, you're going to be spending a lot of money and a bigger percentage of the revenue on R&D than you are going to be in sales and marketing. As the product matures, right, and as we turn more into a sales and marketing company as opposed to an R&D company, then of course things switched over to marketing and sales, and so a bigger percentage of the revenue is going to go towards sales and marketing versus R&D. So as a cop-out way of answering the question, I would say that it's going to change over time. And it's impossible for me to sit here and say you should spend 30% of your revenue on marketing, right? That's not the answer, right? The answer is initially in early stage when there's little or no revenue, the percentage of revenue that you spend for R&D, sales and marketing, and G&A is going to be astronomical, right? Then over time, obviously, as our revenue stream increases, as our expenses as a percentage of revenue decreases, then we'll get to the point where ultimately, we are making money, and it's really when we have a more of a mature revenue base that we can use as I guess kind of the denominator in that calculation, where we can really start thinking about saying, okay, we want to kind of limit our marketing spend to 30% of revenue, for example. So at an early stage, which is what I think I'm talking to in most cases here, that kind of using percentages of spend as a percentage of revenue is probably not very, very practical or ideal. Now, over time, what you're going to want to do is you're going to want to say, and this is where I would say a top-down financial projection using percentages is appropriate, and that is where you say, okay, look, I want to be able to have. I want to be able to drive my business. I want to have our financials showing that we're going to break even by a certain point in time. And to get there, then this is the kind of revenue that I'm going to need, and this is the percentage of revenue that I'm going to need to spend in each of my major departments to be able to get to break even. And I think that that's a good exercise to start and say, okay, this is my goal. But I'm going to warn you and say that you really, really need to do a bottoms-up projection on the expenses, the headcount. Make sure that the assumptions, make sure that those assumptions jive with and make sense, right, with what we know about our business, right? I mean, it's easy for us to put together a model that says, hey, listen, we're going to make $1 million in revenue, and we're going to break even next year on $1 million of revenue. Well, okay. It's easy to make our model say that. However, is it practical, right? Does this allow us to hire enough people to be able to generate the revenue? Does it allow us enough R&D people to be able to complete the product or make enhancements to the product that we know we're going to need in order to get the revenue? And does this cover all the growth in other expenses that we're going to have? So it's a good place to start as a target to get to over time, and I highly encourage we do that over multiple years of showing when we're going to get to break even and what's going to have to happen. But I'm going to be adamant that you need to do the bottoms up financial projections with all the assumptions underlying to make sure that it makes sense with the top line projections. Okay, and then the bottom up, right? And the bottom up financial projections, again, there's probably two ways of looking at this. If we have enough, even before we get to the expense side, even on the revenue side, right? I highly recommend that to the extent that we can start with this kind of top down, using total available market and whittling that down to our revenue base. See if we can match that with a bottoms up revenue projection, right? And the bottoms up revenue projection literally may be things like, okay, this is when I'm going to finish my product. I expect to sign up this many customers over this period of time. This is how much monthly subscription fee they're going to be paying us, or annual subscription fee they're going to be paying us, and that matches with industry norms or standards, or what we expect. We're going to be able to deliver in terms of value. How much marketing spend are we going to? How many people are we going to need to get to those numbers? And is that justifiable? Does that make sense? So still use a bottoms-up means and assumptions to see if we can to reconcile, right, our tops-down revenue projections. But if we don't have some of those metrics initially, we're going to be working towards those, and we may start at the very least with a tops-down. For a bottoms up on the expense side, this is absolutely critical. And I already touched upon this, on the last slide, but really understanding, okay, let's say we have a revenue stream that we are putting into our financial plan, right? So now if we actually use that as kind of the underlying assumption to build our expense model, then we really do have something, right? We do understand how many customers we're going to be signing up. We do understand how much advertising we're going to need to spend to be able to generate that kind of, customer uptake and the revenue stream. We know how many we should have an idea of how many people and who those people are, and when we need to hire those people that's going to support the revenue and the product development that we have in our model. We're going to have an idea of, we're going to be able to use some assumptions about, travel for salespeople. How many salespeople are we going to be hiring? what kind of travel budgets do we need to be putting together? What kind of office space are we going to need for to house the people that we have in our financial plan? Are we going to have a distributed model where we're hiring contractors from different parts of the country? Are we going to have a centralized office where we want everyone to be located and being able to work with one another and see each other face to face? So all those kinds of things are assumptions that you need to develop or have developed, and then using that is basically what you use to put together a kind of a bottoms-up financial projections to get to the expense structure that will support the revenue model that we have in place. And obviously this is going to be iterative, right? Because you're going to say, okay, well, this is the revenue plan, and based upon that, these are the number of people that I'm going to think we're going to need. You'll definitely want to put together just one tab on your sheet that looks at just a head count, salaries and the benefits and all that, and have that roll up. And then what you'll find is that after you kind of go through that exercise of putting together the headcount plan and subsidizing that with contractors and putting in your other expenses like office expenses and rent, office leases and travel, and those kinds of things. And then you may realize that, hey, look, the model is not working, right? Whether it's in some cases it's like we're too conservative with our expense structure, and it shows that we are having to spend too much money to generate the revenue. In which case, then we really need to think about either our business model or the assumptions in our financial model, and kind of go back and look at that. You may find I see, unfortunately, or not unfortunately, but just as a matter of fact, I see a lot of cases where when we put together financial plans like this, that we're ultra aggressive. We think we can do more with less people, and we think that revenue is kind of going to be able to support itself. The growth in revenue is going to be able to support itself without a lot of people, and so I see financial plans where they show that it's going to be we're going to be breaking even after 1 year, when that practically speaking that's not very likely, and even if it is, then that begs the question as to why we're raising financing if we're able to be successful and be profitable within the first year. And so all of those things are you're going to go through multiple iterations. As you do that and you put together these multiple scenarios, which I've discussed, the best case, worst case, and expected case scenarios. As you put those together, then you're going to kind of get into that sweet spot, right, where it kind of makes sense. The revenue plan makes sense, whether you're using a bottoms or tops down only, or a tops down coupled with a bottoms up. That makes sense. Now, and the expense model that we put together, that is hopefully a bottoms up and not just a percentage of revenue or a percentage growth over time. This bottoms up expense structure is going to make sense compared to what our revenue projections are, and we feel confident in it, and we are able to communicate that confidence. The assumptions that we use, we're going to be able to communicate that confidently to investors and potential investors. And all of those things are kind of what going through this process over multiple iterations, using multiple scenarios, understanding our assumptions and how those assumptions all have an impact on our model. So the more time you spend doing this, the more confidence you'll have, and the better able you will be able to communicate that effectively. And again, that's kind of the bottom line. And so, at a high level, that's kind of how we want to be thinking about, putting together a financial plan for investors. And it's not only for investors, right? It should be, somewhat of an operating plan, a long-term operating plan for you as a founder and for your either co-founding team members or your executives or whoever it may be. But that's it. I wanted to leave a little bit of time for some additional questions. So if we can get to those, Patty?
Yes, we have a question. It says, at seed stage, where you typically be funded by angels or an angel group, what percentage of the company are those investors accustomed to receiving? Somewhere around 20%?
Yeah, it's hard to answer that obviously as well. It's going to depend, right? It's going to depend a lot. Ultimately, it is a negotiation, between you and investors. I would say that the dilution that you're going to get is going to be more dependent, on what you've been able to achieve and how many investors you can get interested in in the investment idea, right? So if you only have one potential investor that is looking to raise money and you need that money really, really badly, you're going to give up more of your company. If you have 3 or 4 investors and you're oversubscribed and you're only looking to raise 2 or 3 million and you've got kind of soft tabled 4 to 5 million and everyone wants in, I guarantee you're going to be able to do it and give up less of your company. Right, so it's probably more dependent on that, but I would say 20 to 30%, as a seed would be a good target to be going after. I think that kind of hits a sweet spot. I think just depending on, again, your business model, how quickly you're able to accelerate growth, whether it's a viral platform or whether you have to find customers one by one. All of those things are going to have a big impact. And so it's hard to give kind of a hard number, but 20 to 30% as an initial seed is reasonable.
Okay.
And a good target for us, I think.
We have another question about sorry, I lost it. For investors to consider an amazing opportunity, what TAM size do they usually like to see?
What size?
TAM, TAM.
Oh, boy, I don't know. I mean, obviously, billions is good. I mean, if they're looking at an amazing opportunity, right, that's going to require several things. So it's going to require a big TAM, obviously. And so, it's not going to be a local company, that can only, sell into California or New York or even just the United States. Ultimately, it's probably going to be worldwide, even though the initial segment that you may be going after is going to be smaller. More importantly than that, I would say, well, it's not more important, but just as important is really what the business model looks like, right? So again, I kind of talk about velocity and ability to grow the business, right? So how quickly and how easily is our revenue able to be grown over time. It's not just a total available market, but like what percentage of that market are we able to get and how quickly are we able to get to it? Those are going to be bigger drivers, as big, if not bigger drivers than the actual total available market. I think that they would, that investors would much prefer seeing us being a major player in a slightly smaller TAM or slightly smaller total available market than for us to say we're going after Google's market, right? And we're going to have 0.0000001% of that business. So it's probably it's kind of a mix of those kinds of things. But obviously, ultimately that the revenue potential, right, is kind of what they're ultimately looking for. The revenue and net income potential in the future is what investors are ultimately going to be looking at.
Okay, we have another question. Do you recommend spending the time and money to visually present your financial plan in a certain way?
No, I don't. I think that and this is kind of where we get into some of the intricacies regarding pitch decks, right? Because that's probably what you're asking. You obviously want to have a very, very robust financial plan. In terms of actually presenting that, you're not going to want to present that, right? You're going to want to discuss that during due diligence. So when the potential investor or investors are interested and say, I love the idea. I want to do a deeper dive, right? I want to talk to, potential customers. I want to see where the product development is. I want to meet with your team members, and I want to do a deeper dive into your financials. That is when you're going to want, that's when you're going to want to get a little bit more detailed. From a presentation perspective, I would just say you're going to want one, maybe two slides at the most as part of your pitch deck. And for me, it's usually about things like, just kind of, showing revenue growth over time, and maybe that's by quarter. I usually just present it on an annual basis. So for the next 3 years, kind of what we expect in terms of revenue, and total expenses, and obviously, the overlaying that is your cash requirement. Right, so that's kind of what I think the what you want to show. You want to whet the appetite, right? In terms of actual pitching the idea, you want to whet the appetite of investors. You want to show them confidence that you've thought through the numbers, and you're able to talk to them. But you're not going to want to get into the nitty gritty of showing them kind of the sausage making of putting together the financial plan until and unless they are interested in doing a deeper dive due diligence into a potential investment.
We have another question that says, at the early stage, how should we determine wages in our financial plan? When is it healthy to see lower wages compared to the norm? And when is it healthy to see higher wages compared to the norm, especially for engineering?
Well, so I don't know that there is a time, or during the timeline that you want to show one or the other. They should be reasonable, right? I mean, we don't want to overpay. Like you don't want to put together a plan that says that the CEO is going to make $500,000, right? Salary, right? So usually what happens is in early stage companies that the founding team is the one who's kind of willing to take a lesser salary, right? So the founding team members, because they have a huge equity stake, and so they have a large incentive to make the company successful and to be able to do more with less money, because they're going to see the huge rewards on the back end, right, during an exit. Right, so you want to be probably pretty aggressive in terms of your salary and founding team member salary. You don't want to be aggressive in terms of showing that we're going to hire engineers at lesser salaries just because we're at an earlier stage. Maybe slightly, but the point is it's there's so many good startups out there. That engineers and other key employees have access to, that to put in assumptions that we're going to be paying engineers smaller salaries initially is not practical, and it's probably going to be a giveaway to potential investors that we're not being reasonable, or that our expectations are too high, and we're not going to be able to hire the engineers that we're going to need to be successful. So put in what reasonable salaries are for engineers in the geographic area that you're looking to hire, right? If you're looking to hire someone in the Midwest, then that's very, very different than hiring someone in San Francisco. If you're not familiar with salaries in San Francisco, you're going to be shocked at what you have to pay to get even a low-level engineer. And so, obviously, do your analysis, do your research in terms of what local conditions are in terms of salaries, and pay pay yourself a living wage. Be aggressive with yourself, because investors want to see that you are taking a risk along with them. And the way that you show that is to take a smaller salary initially and more equity, but to actually put together a plan to hire people, you're going to want to put in competitive salaries.
Okay, last question. If you could only show 3 financial data points in the deck, not charts or graphs, just 3 figures, numbers, what would it be? For example, TAM, year 1 revenue, or other?
I'm not sure. It's probably going to depend on your business. I would say obviously revenue at some point in time, right? What revenue we expect to get to, the amount of cash we're going to need, right? So how much cash we're going to burn along the way to get there. And then I would probably be putting the ask right, on that. So this is the revenue we expect to generate. This is how much cash we're going to need to spend over a certain period of time. This is how much cash we're looking for today. So those would probably be the key three numbers. If I'm only going to put in three numbers into into an email or something like that, but I would also highly recommend that you do not limit it to that, because what investor is going to see three numbers and say, okay, I'm interested in looking into this investment, only looking at three numbers? I don't see that as being a practical solution.
Sir, one last question I think a lot of them have. It
Sure.
says, how do you create a financial forecast for pre-seed, pre-revenue, pre-sale startup?
Yeah, that we get that a lot, right? And so I would kind of go harken back to that kind of the bottoms, the tops down analysis that tries to we start with what research we can to find what the potential total available market is, see if we can get that total available market down to a serviceable market size that we're going after initially with our initial product. And from that kind of try to maybe use some assumptions about market share that we expect to win over time as a means of getting to a revenue model over a 3-year period, and then the expense side, it's really impossible to put together an expense structure without thinking about especially at an absolute minimum the people that you have to hire, right? You have to have that in a financial plan, because otherwise, as soon as an investor wants to do due diligence, and they're going to want to do due diligence, right, before investing in you. As soon as they take that next step, it's going to become very, very obvious that we haven't thought through those kinds of assumptions, and then it's going to make us look like we're not ready.
Okay, Sir, thank you so much for this time. I will send you all the presentation and the recording of this webinar. I'll include Sirk on the email, so if you have any other questions, you can email him directly. Once again, thank you everyone for attending, and Sirk, thank you for presenting.
Thank you, Patty, and thank you, everyone. We know how busy your schedule is and how valuable your time is, and so we really appreciate you guys taking time with us today.
Okay, bye.